All right, let's get right into it. Today, we're breaking down the latest earnings from Applied Optoelectronics. You know them as AAOI. And this quarter was, well, it was a wild one. You've got record-breaking results on one hand, and on the other, the stock just absolutely cratered. So what on earth is going on here? Let's figure it out. So, boom, right out of the gate. After the numbers hit the wire, the stock drops 14%. That's a serious haircut. And this is really the core puzzle we have to solve today. Why would the market punish a company for posting its best revenue quarter ever? It just doesn't make sense on the surface. But, as you know, the devil is always in the details.
Okay, so let's start with the headline numbers. And right away, you can see it's a bit of a mixed bag. And here's that conflict, clear as day. On earnings per share, they actually did better than expected. The street was looking for a loss of 11 cents. They came in with a loss of 9 cents. That's a beat. But, and this is a big but, they missed on revenue. Now look, $1 million miss on a $100+ million number might not sound like a lot, but for Wall Street, it was the first red flag. It's that first hint that maybe things aren't going exactly according to plan.
And here's why that little revenue miss is so confusing. I mean, look at this. Year over year, revenue grew by 82%. That's not just growth, that's an explosion. From $65 million to almost $119 million. By any normal measure, that's a fantastic blowout quarter. So what gives? Why the sell-off? The answer isn't in the total number. It's in the pieces of that number, where the growth came from, and crucially, where it didn't. All right, so let's peel back the onion and look at what's going on behind the results, because this is really a tale of two completely different businesses right now. So the absolute hero of this quarter was their cable TV business, or CATV. I mean, look at this. It made up 60% of their total sales. It pulled in a record-breaking $70.6 million. That's up something like 237% from last year. It's just staggering. This one segment basically put the whole company on its back. The problem, though, was the other side of the business. And to their credit, management didn't try to hide it. The CFO, Dr. Stefan Murray, came right out and said it. The strength in cable TV was great, but it was covering up for the fact that the data center business came in light. And let's be clear, data center is the segment everyone's watching. That's the big AI growth story. So when that part of the business stumbles, the market gets nervous. So what was the reason? Well, according to management, it was a $6.6 million shipment that got delayed right at the end of the quarter. They said it was just a timing thing, a hiccup with one of their big hyperscale customers, and that the shipment actually went out just a few days into the next quarter. Plausible? Sure. But when a stock has had a run like this one, the market is priced for absolute perfection. Any whiff of a delay or an execution problem, well, that's a huge red flag. So this is what it all boils down to. This quarter has perfectly set up the battleground for the stock. You've got the bulls on one side, pointing to that insane cable TV growth, the promise of the new 800G AI products, and hey, they're even profitable on an adjusted EBITDA basis. But then you've got the bears on the other side, hammering on the data center delay, the weak guidance for next quarter, all the money they're spending, and the shareholder dilution. Both sides have a really strong case right now. Okay, but here's the thing. The stock market doesn't really care about what you did last quarter. It cares about what you're going to do next quarter. And this is where the real damage was done. The guidance. And oof, take a look. Wall Street was penciling in about $145 million in revenue for Q4. AAOI came out and guided for a range that tops out at $140 million. The midpoint is way down at $132.5 million. That is a huge miss versus expectations. And honestly, it just completely wiped out any goodwill from the strong Q3 numbers. This is why the stock got crushed. Now, on top of the weak guidance, there's another point of concern: the sheer amount of cash they're spending. We're talking about CapEx, or capital expenditures. You know, you got to spend money to make money, and for AAOI, that means building out factories and buying equipment to make all these high-speed parts for the big AI data centers. And when I say they're spending a lot, I mean a lot. They're on track to spend over $150 million this year alone. Think about that. That's a massive, massive bet on the future, and it puts a ton of pressure on them to deliver. They can't afford any more slip-ups or delay. So you might be wondering, where is all this cash coming from? Well, they're raising it by selling new shares of stock. A lot of new shares. They've done some big offerings, they've got programs to sell shares directly into the market, and what this does is dilute existing shareholders. It's like slicing the company pie into more and more pieces. Sure, it's necessary fuel to grow, but it definitely comes at a cost to the folks who already own the stock.
So that's the whole picture, the good, the bad, and the ugly. The big question is, where do we go from here? It's time for the next call, our take on the stock.
Really, the whole story for AAOI comes down to this one question. What do you believe in more? Do you focus on the very real, very near-term risks, the shaky guidance, the cash burn, the dilution? Or do you look past all that and bet on the massive, long-term prize, becoming a key supplier for the entire AI build-out?
Here at Talk Tickers, our rating for applied optoelectronics is market perform.
So why market perform? Here's our thinking. First, that explosive growth in the cable business, it's incredible, but the market knows about it. It's pretty much priced in at this point. The real story, the thing that's going to move the stock from here, is all about the data center and their new 800G products. And right now, that is a total show-me story. They have to prove they can win with the big customers. And until they do, with all the heavy spending and the dilution, the risk and the reward just feel too evenly balanced. We need to see them execute before we can get more bullish.
Okay, so with that rating in mind, let's play out a hypothetical scenario. And I have to be crystal clear, what follows is absolutely not financial advice. But let's just think like a trader for a second. How could this whole story change, and how could someone theoretically play it? So here's one way to think about it. Step 1, the thesis. The market has gotten way too negative, focusing only on the short-term guidance and completely ignoring the massive long-term potential of the 800G ramp. Step 2, the catalyst. What's the one thing that could change everyone's mind overnight? A press release, a simple announcement that they've been officially qualified by a major hyperscale customer for their 800G products. That's the light switch moment. And step 3, the trade idea. You could look at something like long-dated call spreads. It's a way to make a defined risk bet that this catalyst will happen, giving you that big upside potential if they deliver, while capping your losses if they continue to stumble. It's a pure play on that one single event.
And one last time, just to be perfectly clear, this is not financial advice. This has all been for informational and entertainment purposes. You've always got to do your own homework and make your own decisions. Thanks for tuning in.